First of all, we were pleasantly surprised in the second half of last year in the U.S. how quickly inflation fell. It gave us a lot of optimism that maybe it would go all the way back down to our 2% target. But then in the beginning of this year, just as Chairman Powell said, it has moved sideways. And that's raised questions in my mind. Is the disinflationary process continuing, or are we landing to more of a 3% inflation level? I think it's still too early to know, and we need to wait and see to get more confidence.
Markets have been disappointed all year. They had a lot priced in as we started out the year. They've been guided back to about 1 to 2 rate cuts so far this year. You said at Milken the other week that you couldn't rule out a rate hike, even though the bar for that was still high. Now you've seen a bit more data. You've been closely looking at the economy. Can you rule out a rate hike?
No, I don't think I don't think we should rule anything out at this point. We are all committed to getting inflation all the way back down to our 2% target. The most recent inflation print that we got on the CPI data was marginally better than the earlier prints from the first 3 months, but still not where we need it to get to. So it wasn't getting worse, but we just need to wait and see. I think right now we're in a good position because the labor market remains strong in the U.S., so we have the luxury of being able to sit here until we gain confidence on where inflation is headed.
So what we're seeing is a body of water between your commentary and the market expectations. What is it going to take, in your view, to get us to 1 to 2 rate cuts this year?
Well, a lot more, many more months of positive inflation data, I think, to give me confidence that it's appropriate to dial back. You know, the U.S. economy has remained remarkably resilient. GDP growth has been strong, much stronger than forecast. Most people thought that we'd be in a recession toward the end of last year. That didn't happen. Instead, we had very strong growth. U.S. consumers have remained remarkably resilient. The housing market has remained resilient. So I'm not seeing the need to hurry and do rate cuts. I think we should take our time and get it right.
Neel, it's clear then that interest rate hikes haven't necessarily worked as effectively as they may have in the past. Does that worry you at all, that maybe we need to give the Fed more tools, or that the Fed needs to do more in future in order to get inflation back down to whatever target it may be, which of course currently 2%?
I'm confident that we have the tools to get inflation back down. What's unclear to me is maybe some of the dynamics of the reopening of the economy has raised what I call the neutral rate, or what we call the neutral rate, the policy stance that is the minimum level that we need to get to, where we're not stimulating or restraining the economy. If that neutral rate has gone up in the short run, then that means the policy would need to be even higher in order to get the inflation back down to 2%. That's very unknown right now. It's very hard to judge that in real time. And so I think we just need to take more time to assess where the economy is headed.
Do you think a lot of that has been hampered by how much spending government has also put in this reopening of the economy, because that's hampered your progress to getting inflation down?
It's one of the factors that has contributed to the high inflation. I think bigger factors are more on the supply side, with the services sector shut during COVID, with Russia invading Ukraine, pushing commodity prices up, and supply chains that have been gummed up. A lot of the supply chain problems have sorted themselves out. That's led to some of the disinflation. The question is, are we going to get all the way back down to 2%, or does monetary policy need to do the rest of the work?
I was looking at a recent speech that you gave about how many different data points you look at. And I was looking through the same data points, and what jumped out to me is just how bumpy they are. Like retail sales, what we have flat in April after an increase the prior month. So bumpy on that metric. On the housing starts, just after a big fall early in the year, then we get them rising again. On the PCE, we have a fairly flat level for a couple of months, and then we go back up. How difficult is it to read the data? And do you want to see sort of an extension, at least when it comes to PCE, of a lower rate and for longer to give you the confidence?
Absolutely. The data has been very mixed. Our economic models that we normally rely on to forecast inflation, they didn't forecast the rise in inflation, and they didn't forecast the disinflation at the same time. So we're really having to look at the data, and that's why, given all of the mixed signals that we're getting, for me, looking at the actual inflation data, even though it's backward looking, that has got to be where we spend most of our effort, because the rest of the signals are so mixed.
So, for instance, on the PCE, what number makes you feel more comfortable? Is it sub 2.5%?
You know, we're going to have to look at both sides of we've got inflation and the labor market. Ultimately, we have to get inflation all the way back down to our 2% level. But if the labor market starts showing signs of material weakening, then that'll influence how I trade off those two sides of our mandate. But right now, with the labor market, with a 3.9% unemployment rate, for me, we have to be very focused on where inflation is.
You've got You've maintained as well that 2% is the target, right? And that's something you've always been vehement about. But we are in a totally different environment compared to when that 2% target was initially put forward. Then, would you believe that long term, that 2% is still going to be structurally the same and should be the inflation target then as well, especially in an environment where you're seeing government spending as it is, and it may not necessarily slow down?
Well, I think most central bankers and most economists believe that the central banks, whether it's the Bank of England or the Fed or the ECB, can determine the inflation target, and then we will adjust monetary policy to achieve it over time. You're right, the conditions can change, but that just might change the policy rate that is needed in order to ultimately achieve the 2% target. I think it's reasonable to have the debate about whether 2% is the right target, but only once we get back to 2% and then have that debate. It's not appropriate to move the goalpost.
So does that mean that zero rates are a thing of the past? That will ultimately never happen if a scenario like this is basically at play?
Well, I don't want to say never, because in recessions can still happen, even different shocks can hit, and it's possible in the future we would have to bring rates back down to zero again. I don't want to rule that out, but it's nothing that we see on the horizon right now.
Can I pick up on your points around the labour market? I was talking to the Manpower CEO last week. He said, look, the labour market is slowing, but in slow motion. Mm-hmm. As we talk about this 3.9% unemployment rate, somewhat unusual for this cycle, how tight do you think the labour market still is? And what do you want to see exactly from the labour market now?
Well, the labour market is still tight. I talk to a lot of businesses across my part of America, what we call the middle part of the country, and they say that they still have to compete to find workers. It's still a tight, robust labour market, but it's not a crazy labour market like it was a year or two ago, which felt very high pressure, very inflationary environment. So I would expect the labour market is closely tied to the services sector. The services sector is still running hot. I would want to see a little bit more softening in the labor market, wage growth continuing to moderate, to have confidence that the services side of the economy is going to normalize. We're not there yet.
Right. Can I ask you how you feel about words? Because this morning we heard from Loretta Mester saying that she wants to see more detail in the FOMC statements, that perhaps they're too brief, and so market seize upon every single word and the significance of that word. If it's dropped from a statement, then that is signaling something from the market. So do you want more detailed statements? Do you think that would be helpful for the market?
I need to think about that. On one hand, I agree with my colleague Loretta Mester that each word carries tremendous weight and gets tremendous attention. At the same time, few people would argue that there's not enough communication from the Federal Reserve, given all of the policymakers like myself who are out there giving these type of comments. And so I haven't had a chance to read Loretta's comments to understand them in detail.
Yeah, and I suppose just to that question, and I know you said you're going to think about it, but it's just the varying commentary that then comes out of all of it. Is that not as confusing for the market as the initial statement as well, which sometimes can offer a divergence in opinions and views for some?
Well, I think, as we talked about earlier, the data that we're all seeing is so mixed right now. Yeah. It's hard to have confidence for anybody to say definitively, I know exactly where the economy is headed. It's hard for the committee to say with confidence, we know exactly where the economy is headed. So yes, it is confusing, but the economy is confusing right now. And so the confusing communication reflects the confusing reality that we're all trying to sort through, whether it's market participants or policymakers.
Somewhat of a wild card question, because you are in Europe and you are the US Federal Reserve, not the Federal Reserve for the entire world. But there is a view that if you don't get going in terms of cutting rates soon, it has implications for other central banks, undermining their ability to loosen monetary policy. Does that concern you, the consequences you may be bringing for the likes of the ECB, eventually for the Bank of England?
Well, we're aware of these divergences, and the rest of the world affects the U.S. too. So we care a lot about what happens in Europe and in other economies around the world. But ultimately, our mandate is to the American people to set monetary policy for the U.S., just like the Bank of England does for the U.K., just like the ECB does for the European Central Bank. And these divergences can go on for a while, but then over time, advanced economies tend to move somewhat together. And so I'm not that worried about divergences in the short term.